Okay, so I wanted to create a guide for how to invest in the stock market if you're a beginner. And I wanted to do this because I think it's such an important skill for the time that we're living in. And we don't do a good job educating people on how to do this. Um, the whole system we live in, the whole economy that we live in, the whole thing serves asset holders. Um, so if you're an adult, if you're working, you want to try to become an asset holder as fast as possible. Um, you want to try to be an investor because the whole system serves them. So that's why it's really an essential skill to try to be in the stock market as soon as possible. A little bit about me. When I was in my mid 20s, when I was 25, 26, I worked for a short time at a bank as a teller. And I really grew up without any financial education. So I didn't know what a stock was, I didn't know how to invest. I was not investing by that point in my life. But working at the bank sort of it just introduced me to this whole sort of environment of finance and wealth and thinking about money for the first time. And that it just caused me to start asking these questions. And over the years that I was working at the bank and the period after it, I really went through this whole process of financial education. And I was asking these sorts of questions. If you have money, how do you turn it into more money? If you have wealth, how do you grow your wealth over time? By this point, I had saved a little bit of money already. And where did I put it? I put it in a savings account because that's what you grow up, learning how to do. Put it in a savings account. There's a great quote which I'll get to later, which is quote that rich people don't use banks, and it's a great line about sort of getting into this world and understanding this world. It's not that they don't use banks for a checking account, but it's that they don't put their money in a savings account. They invest it into assets that grow and appreciate over time, and that's how you really build wealth. And actually, a savings account, which we can sort of unpack later on, maybe in more detail. Um, the really low interest rates on savings accounts, you're actually losing money over time due to inflation. So in order to retain your wealth, the money that you do have and how to grow your wealth, you really want to be investing it in assets so it will grow over time. So around this time, when I was working at the bank, most of my education, I would say, it came from just studying and learning from Warren Buffett. Um, if you've never heard of Buffett before, he's one of the most famous stock market investors of all time. He's the chairman of a company called Berkshire Hathaway, and he really has this great philosophy of life and investing that is, in my opinion, the most responsible way to build wealth using the stock market. And it's really about these values that he has and that he lives, being frugal, living below your means. Um, when you're choosing stocks, when you're choosing companies to invest in, identifying quality companies that have resilience and that will be around for a long time. Companies that have competitive advantages. This is called a moat against its competitors. Identifying quality companies, buying quality companies, and holding them over the long term is how Buffett builds his wealth. There's a thought experiment that I think I got from Buffett, and he says in one of the interviews, he says, if you were to get in a time machine and come out 10 years later, what companies would you want to have bought and have in your portfolio today. So your portfolio is just a term, and it's all the wealth that you're putting into assets as a whole. We call that your portfolio. What company would you want to buy today that 10 years from now it will still be around and it will be more successful and it will be building wealth even into the future? The other thing that I really derive from Buffett is that investing really isn't about how intelligent you are. It's really about emotion and self-discipline. So there are intelligent people who actually they're very unsuccessful with the stock market, and they lose wealth in the stock market. But if you have these good traits, these virtues, you don't have to be extremely intelligent, and you can build wealth over time as an investor. Okay, so let's go through and we'll sort of go simple idea, and try to unpack each one and try to get this general picture of how to invest in the stock market. So the first question is, what is a stock, or a share? We call them shares as well. So if you think of money, like paper money, like in your wallet, like a dollar bill, paper money is a certificate and it represents something. And, paper money, you used to be able to exchange it for an equivalent amount of gold or silver. A stock is similar in that it represents partial ownership in a company. And so, you get something like this, like 20 shares of Standard Oil. And it represents partial ownership in that company. So for example, like you take Standard Oil and you divide it into 100 shares, and then each one share you own 1% of Standard Oil. And that partial ownership gives you a claim on the profit, on the wealth that's being created by that company. And as the company grows and expands and appreciates over time, your share will similarly grow and appreciate over time as well. Today we don't have these. We don't really have these fancy certificates anymore. Today everything is really digitized, and we have these modern stockbrokers which you interact through apps or through websites, and the whole thing sort of looks something more like this. So if you're getting involved in investing for the first time, we have Fidelity, we have Vanguard, we have Robinhood. These are some stockbrokers that we have in the US. You make an account, and that's how you participate in the market. You deposit money, and then you can identify shares, type in the ticker symbol, the abbreviation for the company, and then you can buy and sell shares in the stock market. Where does the stock market comes from? So it originates with the Dutch, and one origin of it is the danger of financing a ship to go to the East Indies. Was something that had a lot of risk in it. And if you were just one investor and you would charter a ship and it would go to Indonesia and then bring back spices and sell them in Holland, a lot of things could happen. There could be pirates, there could be all sorts of disasters that could happen to the ship. So the idea was, so what if instead of one investor, you have 5 investors and you break it up 20% each, and you put in like 20% of the starting capital, and then if the ship, crashes or something happens, you only lose that percentage instead of the cost of financing the whole journey. So you have the Dutch East India Company, which was the first publicly traded company. You have the Dutch Stock Exchange, and then later it translated to the British, Stock Exchange in London, and then the New York Stock Exchange here in the U.S. A bond, so we can talk about this maybe in more detail elsewhere. A bond is another tool for how to invest. The the main ways, if you have wealth and you want to try to build wealth over time, you can put your money in a savings account. You can put your wealth in a bond, and you could put your wealth in a stock. So a savings account, you're basically giving money to the bank. Have you ever asked this question before? How do banks make money? So the simplest kind of bank is just a savings and loan bank. And you have people who deposit money, who are savers and have savings accounts. And then you have people who go to the bank and borrow money and take out a loan and take out a mortgage from the bank. So basically what a bank does is the depositors put their money in it, and then they get interest on their deposits. And then the bank lends that money to borrowers, and the interest that they charge is higher than the interest they pay on the person with the savings account. So that difference is the profit on a bank. So when you have your money in a savings account, like it's insured by the FDIC, so it's safe in the bank, but you're actually lending money to other people through the savings account. That's how a savings account actually creates wealth. Stock, we already said, is partial ownership in a company, okay? And then if the company appreciates and grows over time, your stock will appreciate. And then if the company is making a profit, they will distribute part of that profit to you in the form of what's called a dividend. So they'll pay you a little income, every 3 months usually, 4 quarters a year, distributing part of the income that the company itself is making by selling products. And then your stock can also appreciate as well. A bond is another way of lending money. And so bonds represent debt. Okay, so they represent the debt either of a government, let's say a town or a state or the US government. The most famous kind of bond like this is what we call a treasury bill or a treasury bond. And if you buy a treasury bond, think of when Congress spends money that it doesn't have, it issues treasury bills. And when you buy a treasury bill, you're essentially lending money to the government that the government pays interest on, and then you get that interest, and then eventually they'll pay you back the value of the bond, the principal back, at the end of the duration of the bond. Bonds are also issued by companies. So if a company needs money, and let's say the company wants to expand and wants to sort of have a second location or a third location, and it needs capital. So capital is just the economic term for money. It can either issue stock, so issue stock to new investors. That's one way it can raise money, and the other way it can raise money is by issuing bonds. And so they're when they issue bonds, they're borrowing money, and then you're lending money to the company. We can unpack these in a little bit more detail below, but I had the word bond here, so we unpacked what that meant. So how do you make money from a stock? Well, we already sort of just covered it just here. It's called appreciation. So if you think of a pie, so if you divide the pie into slices and you own one piece of the pie, if the company grows, if the company is successful, if the company is getting larger and more profitable over time, the pie will actually get larger, and your slice, your share, will grow as well. And so we call that appreciation in the stock market. When you invest in the stock market, there is risk, there is danger involved. If a stock goes up, it can also go down, and we call that depreciation. And the day-to-day fluctuation in share price, we call that volatility. And some companies are more volatile than others. Some companies, when you analyze their stock charts, they're very pacific, and they sort of grow in a steady pace over time, over long stretches of time. Other companies have these big swings where they'll appreciate and then they'll have a massive correction right, or a crash in value. um, and you have to decide what your investing style is going to be, what types of shares you want to invest in. The other danger when you invest in the stock market is if a company goes bankrupt, its share price goes to zero. And if its share price goes to zero, you lose all of the money that's invested in the company. So that's a very dangerous thing that can happen. um, Generally speaking, if you invest in quality blue chip companies, or if you're investing in index funds, and we'll explain what index funds are as we sort of go further through this, blue chip companies generally don't have this danger. There are some famous scandals like the Enron scandal where this did actually happen, and people who had all their assets, all their retirement accounts in Enron stock, they basically lost everything. So it can be it's one of the reasons you want to what's called diversify and sort of spread your assets out, spread your money that you invest in the stock market out amongst multiple different companies, and not just put all your eggs in one basket because of this risk. Okay, so let's transition to these ideas and try to unpack them now. So when you're investing in the stock market, you're buying and selling shares in what are called public companies. So there are these two types of business. You have private companies and you have public companies. To give you an example of a private company, pretend that I, Alexander Lorenz, I have some wealth of my own, and I buy a building, and I buy textiles, and I buy looms and machinery, and I hire some employees, and we start making clothes and then selling the clothes. You would call this a private company. You would call this a sole proprietorship, where I'm the sole owner of the business. I put up all the capital, so I own it myself. If I have a friend or an investing partner or a business partner, and we put it in the same amount of capital, and we split ownership 50-50, you would consider that a private company. If a private company is doing well and it's being successful, a lot of the time it will have what's called an IPO, or an initial public offering, and that private company will, quote, go public, and it will become a public company and be listed on the stock exchange. So you can't buy stock in private companies, but you can buy stock in public companies. When the company goes public, it raises a large amount of capital that can then be used to expand the business. So let's pretend I was the sole proprietor, and we decide that I'll keep 5% ownership, and the other 95% will be listed on the stock exchange. And when that happens, the company raises a huge amount of capital, and it can then buy a second location or a third location, and it can really expand and grow the business. So an IPO can be a really critical time in a company sort of taking off and growing and expanding into the future. Sometimes we have these terms primary market and secondary market. Primary market refers to this, it refers to the IPO, and secondary market is just another term for the stock market. So when you're buying and selling shares every day, you're participating in the secondary market. A company only makes money, it only raises capital in the IPO, and then when it issues shares, it's not making any money itself in the day-to-day buying and selling of the shares on the stock market. So if a company doesn't make money after listing these shares, why do they care about their share price? So the share price represents the health of the business, the success of the business, the growth of the business. Oftentimes the managers or the employees in the company will own stock in it, so they're succeeding as the company is growing. If the stock price is doing well, it's easier for the company to do things like borrow money. So those are some of the reasons that they do care about their share price after the IPO. Previously, we asked the question, um, how do rich people, quote unquote, how do rich people invest their money? And we said that, quote, rich people don't use banks. And we talked about these ideas, and we said that if you want to build wealth, you really need to be an investor, and you want to try to buy and accumulate assets, and ultimately we were arguing that you want to participate in the stock market. So if we just do a quick comparison here, and if we look back over the past 20 years or 25 years, going back to the year 2000, and just sort of compare the sort of average annual return for each of these investment options. Savings accounts have generally been very poor performers. The interest rates back in the 2000s and the 2000s, the 2010s, the 2020s, the interest rates were very, very low, and often you would get like 1% interest from a savings account. A bond might yield something greater, maybe 3 to 5%, and then investing in the stock market, you might get something better, like 9 to 12% annual return. This is changing now. The economy has been changing over the last few years, but generally speaking, when you have the option of these different choices for where to invest your money, the stock market is the best choice. And then if we look at these and compare it to this problem of inflation, this is the real reason you want to invest in the stock market. So every year, as the government prints money and expands the money supply, the purchasing power of each unit of currency is decreasing. And let's say there's 3% inflation, this year. If you have $100 at the start of the year, and then you go into next year, the purchasing power erodes and it goes down to the value of $97. This happens so sort of invisibly in the background that we don't see it sort of day to day or year to year. But due to inflation, you want to at least match inflation to retain the value of your money, and you want to try to exceed inflation and actually appreciate and grow your wealth over time. So the stock market is really the best tool to building wealth over the long term. Okay, and so that's why stocks are more appealing than other forms of investment. Why have savings accounts been such poor performers? It has to do with the Federal Reserve and what's called the federal funds rate. And the Federal Reserve policy, this is, like I said, this is in the process of changing now, but dating back to 2000 until relatively recently, the Federal Reserve policy, so the overall economic policy of the country, has made it so the stock market is really where wealth should be distributed if you want to build wealth over time. Okay, so here's Warren Buffett. We talked about him a little bit previously. So he's this famous investor. He's built all this wealth in the stock market. We talked a little bit about his values before, so we're just sort of reiterating some of these ideas here. He's famously frugal. Despite being one of the richest people in the world, he still lives in the same house he purchased when he was 27. He doesn't have a driver. He drives his old Cadillac to work every day. Buys an Egg McMuffin, right, for $3.17 every day for breakfast, and he drinks cherry Coke. And then I think we touched on some of these ideas before. Maybe we can sort of expand on them now. So Buffett's strategy of investing is what's called it's called the buy and hold strategy. So he identifies quality companies, he buys them, and then he just holds on to them and doesn't touch them, doesn't sell them, and just sort of forgets about them, if you want to think of it from that perspective. Buy a company and then hold it for 20 years, 25 years, 30 years, 40 years. That's Warren Buffett's strategy. He has this famous quote to see yourself as a part owner in the business. So even though if you buy a share of Google and you only own 0.0001% yourself of Google, it seems so minuscule to still see yourself as a part owner in the business, and that you're in it for the long haul. And then we said these same ideas: identify quality companies that are resilient, that have moats, that are going to be around for the long term, and buy them. And how does Buffett build his wealth? He takes advantage of this really, really powerful mathematical principle which exists in the world of finance and investing, and it's called compound interest. And what compound interest is, or what compounding is it's the idea that wealth builds upon wealth. That your money, the more you have, the easier it is to grow more money. And it's this mathematical principle that you can kind of see an example of here. So let's say that you're investing in the stock market and you buy $1,000 share, and it's going to appreciate by 10% a year. Okay, so the first year you make $100, you make 10%. Okay, the second year your principal has now grown, okay, to 1,100, and now it's going to grow by 10% again. Okay, so this is sort of like where the magic happens. 10%, the 10% is not of the original 1,000, it's now of this new value, which is 1,100. So 10% of that is now 110. So this is the idea that wealth builds on wealth, and the more you have, the easier it is to get more. Okay, so then by year 3, right, it's not not making $100, you're making 121. And as time goes forward, you can see what happens. By year 10, right, you're making $236 a year for 10%, 612, right, over 1,500, right, over 4,000. And the way compound interest works is you really need time. And it's time that allows sort of the mathematical magic of this to really happen. So you can see that over the span of Buffett's life, most of the wealth he built later in life. And this is why it's really about values and responsibility and having a long-term perspective, and being able to delay gratification. And it's really more about this emotional self-control over your intelligence that allows you to take advantage of this financial principle. To give you another example, if you've ever seen the show Futurama, Futurama is about Fry, and Fry is from the 20th century. He's from 1999, and he's a 25-year-old who gets accidentally cryogenically frozen, and then he wakes up like 1,000 years later. And one of the jokes in the show, and they have a whole episode on it, is in 1999 he had 93 cents in the bank when he was frozen, and then they kept his account for him, and then 1,000 years later he checks the account, and it's been actually appreciating by 2.25% every year for 1,000 years. So in the beginning, right, the gain is small, but as time goes on, it starts to really snowball and appreciate. And the power of compound interest at creating wealth, he becomes a billionaire in the episode. And then one more example of this. This is a story from the Bible, and it's called the Parable of the Talents, and it's in the Gospel of Matthew. And it's just a great example of this sort of ancient wisdom, and it's the idea that those who have get more, and those who lack, even what little they have, will be taken away. And there's actually a term for this, and it's called the Matthew effect, or the Matthew principle. So there's like a parable, so I'll just read it to you. So there was a man going on a journey who called his servants and entrusted to them his property. To one he gave 5 talents, to another 2, to another 1, each according to his ability. Then he went away. He who had received the 5 talents went at once and traded with them, and he made 5 talents more. So also he who had the 2 talents made 2 talents more. But he who had received the 1 talent went and dug in the ground and hid his master's money. Now after a long time the master of the servants came and settled accounts with them. And he who had received the 5 talents came forward, bringing the 5 talents more, and he said, Master, You delivered to me 5. Here I have made 5 more. The master said, Well done, good servant. You have been faithful over little. I will set you over much. And he who had the 2 talents came forward, saying, Master, you gave me 2 talents. Here I have made 2 more. And he said, Well done. You have been faithful over little. I will set you over much. And he who had received the 1 talent came forward, saying, Master, I knew you were a hard man, reaping where you did not sow, and gathering where you scattered no seed. So I was afraid, and I went and hid your talent in the ground. Here you have what is yours. But the master answered him, You wicked servant. You knew that I reap where I have not sown, and gather where I have scattered no seed. Then you should have invested the money, and at my coming I should have received what was my own with interest. So take the talent from him and give it to him who has the 10. For to everyone who has, more will be given, and he will have an abundance. But from the one who has not, even what he has will be taken away. Okay, so let's just sit with this and sort of unpack this together. So this is in the Bible. This is a biblical story, and it's a Christian parable, but it's pretty brutal, and it's really teaching you an essential principle of life, a very harsh principle of life. The rich get richer, and the poor stay poor. So if we look at some of these sort of compound interest calculators, or if we think of like what a 10% capital gain is, if you have $1,000, 10% is you're gonna make $100. If you have $45,000, 10% is gonna make you $4,000. Certain expenses in life are fixed. If you buy a chicken or if you buy milk, that's the same price for everyone, and so you can buy the chicken and the milk very easily with the 4,000 and not so much with the 100. We live in a world, in a time with this massive wealth inequality, and it's a really very harsh, cruel reality that we live under. Governments do have progressive taxation and other policies that try to alleviate this effect, but we overall don't do a good job at redistributing wealth in the economy. So just simply knowing that this is the reality, you have to approach life and approach money understanding this. And that's why you need to try to be an investor, and you need to try to make these mathematical principles work in your favor and not against you. Okay, so we can look at Fry and we can look at Warren Buffett. Warren Buffett in particular, because he's a billionaire, it's maybe not that encouraging or not that inspiring. But to sort of show you that these principles are really powerful, and that even humble people can use Warren Buffett's philosophy to build wealth and grow wealth over time. I'll give you this example, and this is the story of Ronald Read. And he was a janitor from Vermont, and he lived a simple, frugal life, and he saved aggressively, and he invested his wealth in the stock market, and over time he grew and amassed this sort of large fortune, which he later donated when he passed away. So if we just sort of look at it quickly here, you don't have to earn a massive paycheck to become a millionaire. As one-time Vermont-based janitor and gas station attendant, Ronald Read demonstrated you can reach the 7-figure mark on a modest salary. Now notice his age, that he lives to be 92, and so a lot of the wealth is really built late in age for people who followed these economic principles over a lifetime. So he amassed an $8 million fortune thanks to smart spending and investing habits. Even his family was extremely surprised on learning about his hidden wealth. They knew he was a hard worker, but I didn't think anyone had an idea that he was a multimillionaire. He came from humble beginnings. He was the first in his family to graduate high school, and he served in North Africa, Italy, and the Pacific Theater. After the war, he came home to work at a gas station and a janitor at JCPenney, and married a woman who had 2 children. He maintained a frugal lifestyle, never spending money unless he had to. Friends remember him driving a second-hand Toyota Yaris, using safety pins to hold his coat together, and cutting his own firewood well into his 90s. I'm sure if he earned $50 in a week, he probably invested $40 of it, said friend and neighbor Mark Richards. He was also a good stock picker and had the control to hold on to stocks for the long haul, a strategy billionaire investor Warren Buffett recommends. Mr. Reed owned at least 95 stocks at the time of his death, many of which he had held for years, if not decades, the Wall Street Journal reported. Among his longtime holdings were blue-chip stalwarts like Procter & Gamble, J.P. Morgan, General Electric, and Dow Chemical. When he died, he had large stakes in J.M. Smucker, CVS Health, and Johnson & Johnson, the publication said. So blue-chip companies are basically large, established, reliable businesses that you probably already know, if you live in the U.S. What are the companies you use every day, the products you see every day? If you have toothpaste, you have Procter & Gamble. If you buy Coca-Cola, that's another blue chip company. Google, Amazon, Microsoft, if you have Windows Computer. These are big, reliable, established companies that aren't going anywhere. So just buy in large quality companies and hold on to them over the long term, and it builds wealth over time. And then when he passed away, he left $6 million of his fortune to the library and hospital. It was the talk of the town. The library really benefited from this money, and so did the hospital. And that was it. And so it's just sort of it's a story to show that you don't have to be a wealthy, rich person who comes from great advantages. You can follow these principles and build wealth over time. Here's another example, and it shows the difference between income and asset accumulation. So this compares between someone who after high school immediately got a job working for UPS and worked full time and invested the money in the stock market with a high savings rate, and someone who went to med school and then became a doctor. So let's say the UPS driver had a lower salary. Let's say they made anywhere between 30 grand or 60 grand a year, and let's say the doctor is making 100 grand or 200 grand a year. There's a delay because he has to go to school and education. He goes into debt and he has to pay off his debt, and so the physician is income rich, but it takes a longer time for him to start investing and building wealth. The UPS driver, meanwhile, if they're following sort of the Ronald Reed or the Warren Buffett strategy, they can get that compound interest snowball going faster, and you can see the effects. So the ideal here is you have enough assets where you can live off of your assets, and that's sort of the idea if you're following the method that's shown here. Okay, so let's transition and let's sort of unpack some of these new ideas. Okay, so let's talk about this. Let's talk about index funds. Okay, so when you invest in the stock market, let's pretend that you make an account, with Fidelity or with Vanguard, or if you get an account with Robinhood, which is a popular app you can get on your phone, and you are intimidated. Okay, so one of the things you can do is you could research companies. Here's one approach you can have. Think of the goods that you use every day. What do you buy at the supermarket? What are the products that you're using now? Am I on a Windows computer? Okay, and so what you do is then you say, look up Windows. Okay, here's one method you can follow. Okay, and then if you go on Wikipedia, it shows you, well, who's the developer of Windows? And you click on Microsoft, and then you go on this sort of sidebar in Wikipedia and says, okay, Microsoft is a public company, right, not a private company, and it's treated as the ticker symbol, the abbreviation MSFT. And so then if you were to go on Robinhood, or if you go on Vanguard, you would type in Microsoft, MSFT, and then you could buy shares in Microsoft. So that's one idea, is to get ideas from the goods that you use every day, or that you see other people buying. That's one way to get investment ideas. And then think of those ideas that we mentioned before. What companies will be around for the long term, that are resilient, that will, if you get in a time machine, get out 10 years later, what businesses will be successful 10 years or more into the future. Okay, and you can create a starting portfolio with some modest diversification, so sort of spread your wealth out over like a small number of companies when you first start out. A good starting number when you first start investing, let's say 5. Pick 5 stocks, 5 companies that you like. Spread your wealth out across them, and then as you keep investing over time, you can add to that. You don't have to stay in the 5. You can expand that to 10 or 15 or 20 or more. But that's a good starting level of diversification, of spreading your wealth out, without taking on excessive risk. That's one approach you can have. Another approach, if you're too intimidated to pick individual stocks, what I recommend you do is you buy what are called index funds. What an index fund is, well, they were pioneered by this guy. His name is Jack Bogle. And Jack Bogle was the founder of Vanguard. And an index fund is sort of like buying a basket of stocks or a group of stocks. We have these index funds, we have these composites in the country. The most famous are called the Dow Jones, the NASDAQ composite, and the S&P 500, or the Standard & Poor's 500. And when you buy a share of the S&P 500, it's like buying a small piece of 500 different companies. So to give you an example of this, right? So let me click on this on Wikipedia. Okay. So the S&P 500, each one has a philosophy that governs it. The NASDAQ are the tech companies. The Dow Jones are the old economy companies. And the S&P 500 are the 500 largest companies in America. And if you look at the list, so 3M is, so there are 500 of them. There's 3M, AbbVie, Adobe, right, Aflac, Airbnb, right, Allstate, Google, Amazon, American Express. So if you buy one, so think of it this way: if you buy one share of the S&P 500, it's like buying a small piece of 500 different companies. So this basically gives you intrinsic diversification. And this index fund, if one of these companies does poorly and drops off the index fund, a new company will take its place. So the volatility, the rise and fall of different companies is sort of built into owning an index fund. If you buy the S&P 500, it's like buying a part of the American economy. And as long as the American economy is continuing to grow, then it's going to build wealth for you over time. So if you don't know what you're doing and you're intimidated, if you don't know what you're doing and you're too intimidated to pick individual stocks, buy index funds. Okay, so let's move forward and unpack some of these ideas now. Okay, so every company in the stock market has an abbreviation, and so we call that either the stock symbol or the ticker symbol. So for example, Coca-Cola has the symbol KO, Amazon has the ticker symbol AMZN, Google I think is GOOGL, Microsoft is MSFT. So for example, when you watch, it's just abbreviations. So if you watch finance news or like the finance channel, usually you'll see them on the bottom. It'll be like KO up to, AMZN, down 3. It's just abbreviations that they use to buy and sell the shares. Diversification, we kind of touched on before, and it refers to how you spread your wealth out in your portfolio. So if you have $1,000 and let's say you put it all into Microsoft, you would say you have a concentrated portfolio. If you have $1,000 and you spread it out 25% in each of these 4 different companies, you would say you have a diversified portfolio. So this is something that you have to be thoughtful about when you're an investor. And it's a question of risk and reward. Excuse me. So let's say Microsoft appreciates by 400%, okay, over a period of time. And Coca-Cola appreciates by 12%. Okay, now if you were concentrated mostly in Microsoft, you would be reaping the reward of that capital gain. If you're spread out, then you're diluting the return that you would make. However, here's the danger if you have a concentrated portfolio. Let's say Microsoft, crashed by 40%, and you are fully invested in that, and then you would wish that you had diversified your portfolio. So it's something that you have to come to your own method about and find something that's comfortable for you. As I said before, I recommended when you first start out, pick 5 stocks that you really like, 5 companies that you really believe in, and that's a good balance of concentration and diversification for your first portfolio. And then as your assets appreciate over time, add to that 5 and go up to 10, 15, 20, and so forth. That is, of course, if you choose to invest in individual companies and then don't want to invest in index funds. Okay, so in the world of investing, there are different styles of investing. So these are the terms that you often see. So there's value investing, growth investing, and dividend investing. Dividends we haven't explored yet. A dividend is a distribution of profit by a company. And let's say 4 times a year for each of the quarters of the year, a company, when it makes a profit, it distributes part of that profit to each shareholder. And so you get it in your account, right, in your brokerage account. It's just deposited right into it as your dividend. And you can choose to take the dividends and buy more shares with it, or take it out and spend it. And one strategy of investing is to grow your portfolio so that you can actually live off of your dividends. There's a famous quote about J.D. Rockefeller that the happiest part of his day was getting his dividends. And so there's a whole style of investing, and they're called the dividend aristocrats. And there are these different lists of dividend aristocrats, dividend kings, and these are companies that for 10, 15, 20, 30 years, they've paid a dividend and they've raised their dividend over time. And so these are companies that your whole strategy can be focused on getting these distributions. Growth investing is trying to pick companies that have a lot of potential for expansion in the future. Often these are tech companies. Oftentimes these companies don't pay a dividend. When a company distributes a dividend, they're giving the capital to you, the shareholder, meaning they're not keeping that capital for themselves, which could be then used for growth. So companies that don't pay dividends, the share price might appreciate more as a company expands because they're keeping that profit to grow. A dividend company may appreciate less, but then you're getting the dividend distribution as an income. Value investing means trying to find companies whose intrinsic worth is greater than what the market is valuing them at. So if you want to think of a company that's sort of on sale, it's a company that people just don't see the value of, and it's undervalued. And so if you buy an undervalued company, you wait, and eventually you hope that it will later be priced correctly and it will appreciate to its true intrinsic value. And so there's a style of investing that's associated with Warren Buffett's teacher. His name is Ben Graham, which is called value investing. Okay, so let's move on and talk about some of these terms now. Okay, so there's a great finance writer, and his name is Robert Kiyosaki, and he wrote the book, which is called Rich Dad, Poor Dad. And it's about his childhood, and he grew up with his father. He had one father who was a professor. He had another father, mentor figure, who was a businessman. And they had totally different approaches to money. And it talks about how Kiyosaki sort of learned his sort of economic philosophy by the sort of second father he had growing up. And it's a good book. It's a good read, and it's very good for people who are getting interested in this world of finance. And what I wanted to do is the most important lesson from Kiyosaki is this one line right here, which is the correct definition of an asset. Okay, so let's look at these terms. So an asset, by the dictionary definition, is it something you own that has value? That's an asset. And a liability is something that costs you, right? That's a deficit, that's an expense to you. Okay, now what Robert Kiyosaki does is he sort of tweaks these terms and makes them a little bit more aggressive, and this is sort of the difference between someone who wants to build wealth in their mindset and someone who isn't looking at it in such aggressive terms. So he defines an asset as something you own that pays you to own it. And a liability is something you own that costs you to own it. Okay, and once you put it with these more aggressive definitions, this is when you really sort of see the difference in approach, the economic approach to life it creates. So for example, okay, the house that you live in is a liability. Okay, it costs you to own it, right? Either the mortgage or the taxes that you pay every year. A house that you own that you rent to someone else and they're paying you rent is an asset. It pays you to own it. Okay, that's the difference. The car that you own that you drive to work has depreciation. You have to pay the maintenance. You have to pay the gas. You have to pay the taxes. The car that you drive to work is a liability. Okay. An asset, if you think of a stock that pays you a dividend, you own it. It has value. It actually appreciates in value, and it pays you to own it. It pays you a dividend. If you have a bond, right, you have the bond and it's paying you the interest on the bond. That's an asset. It pays you to own it. So you want to accumulate assets and avoid liabilities. Equity is the total value of all your assets. And then net worth is a related term here. And how you calculate your net worth or your equity is you take the value of all your assets and you subtract your liabilities. Okay, so we talked about how Warren Buffett, he has this philosophy of being frugal, and Ronald Reed, he has this philosophy of being frugal, not displaying ostentatious wealth and these sorts of ideas. Someone who owns a fancy car and dresses, wears all these expensive clothes, it doesn't necessarily mean that person is wealthy or has a high net worth, because they could have borrowed money, they could be in debt to afford all these things. You really want to have assets, right? There's a quote: if you have $20 in your pocket and no debt, you are better off than a good percentage of the country. And it's referring to people who actually have a negative net worth, people who aren't in debt. So this is how you calculate net worth. To get into some of these further terms here, okay, so a bull market refers to when the stock market is generally going up and appreciating in value, so it's sort of a cycle in the market. We have what's called the business cycle. Okay, so let's talk about this. So it's just this recurring cycle that happens in the economy. And generally what happens is we'll have like 7 to 12 years of economic growth and expansion. And during this time, the economy is growing, people are being employed, their wages are going up, their salaries are going up. And then after this, it's followed by maybe 1 to 3 years of economic contraction, okay, in which there's a recession, or we have a depression, so think of the Great Recession or the Great Depression. People lose their jobs, businesses go bankrupt, the economy contracts, the business isn't growing, and then usually there's a crash in the stock market. And then after that, the economy will then be in pain for a while, but then it will recover, and the economy will then grow again. And the idea is that each phase of this, even though it's followed by a crash or contraction, the economy is still growing overall over the long term. So a bull market refers to this period of growth, and you see that in the stock market, and a bear market refers to this period of contraction. Okay. When you buy a stock, okay, let's say I buy Microsoft for $100 and it appreciates to $120, you would then say that I have a capital gain, okay, of $20. And let's say it depreciates to $70, you would say I have a capital loss of $70. So there's a difference here. You would call it a paper gain or a paper loss on the one hand, and then a realized gain or a realized loss on the other. So you can have this gain, but you don't incur the tax penalty. You don't pay the taxes until you actually sell the share. And the same thing, the loss isn't realized until you actually sell it. Okay, so, the approach you want to have here is you want to follow a tax strategy, that benefits you based upon the way taxes in the stock market work. So you only deal with the tax liabilities when you sell the shares, okay? So one approach is when you have losers in your portfolio, you sell them. And you can write off some of your losses in the stock market off of your taxes, because the government is trying to encourage people to invest and prepare for their retirement by investing in the stock market. So you can do it's harvesting those losses each year. And the other thing is, when you have capital gains in the stock market, don't sell the shares, but let the quote winners ride. Let them continue to gain and compound over time. And when you do this, you're deferring paying taxes on the shares. So this is something Warren Buffett, who's owned some companies like Coca-Cola for decades and decades, you defer taxes. And so if you think of it, you're getting untaxed gains on untaxed gains on untaxed gains. So you taking advantage of the way capital gains taxes work is a big strategy that you should take advantage of. When you receive dividends, you pay capital gains taxes on the dividends. So you can avoid picking dividend stocks, and then you don't pay the capital gains taxes on them. We already went over this term. So when there's a bear market, when there's a contraction in the economy, you'll have a correction or a crash. And to go over some of these terms here. So when you buy a stock, you want to look at the valuation of it. So think of when you buy something at the store. Is something at the store priced correctly? Is it on sale, so it's for cheap? Or is it overpriced and you're being gouged? So when you look at the stock, you don't want to say, oh, it's $80, it's cheap. That's not how it works. You want to look at the fundamentals of the company and discern if that $80 is an appropriate price for the share. Okay, so you look at the fundamentals. How is the company doing? Is it profitable? Is it successful? Is it growing? And you have these different valuation metrics. And so the most used are called the price to equity ratio, or the PE ratio, the free cash flow, or the price to expected growth. And a really great tool to look up this information for different stocks in the market is it's called Simply Wall Street. And if you go to this website and make an account, they will actually give you this information in a simple, nice visual. And you can see the cash flow of your company. Is it valued correctly or overvalued? So in this case, let's see, this is Lockheed Martin, right? It was overvalued at this point in time, right? You can look at it based on the PE ratio and the price expected growth. And you can use this as a tool when you're valuing stocks. Okay, so the goal today was to give you a basic introduction to investing in the stock market, and I hope that this conversation was helpful to you.